Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And here I am in my garage looking at my Lamborghini. No, I'm just kidding. But here I am in front of my computer looking at my first lien interest only HELOC for $280,000, right? I got access to it Friday night, which is about 2 days ago. And so I have a first lien HELOC, right? But I actually had a 2.8% mortgage because I got it in early 2020. And so when I here's the thing, I actually did not replace my mortgage with the HELOC, right? I actually paid off the HELOC first. I'm sorry, paid off the mortgage first, and then I got a HELOC, therefore making it first lien. Now, I know there are some of you out there because I get these emails where it's like, I got a really low percent, interest rate mortgage, and I'm thinking of replacing it with a home equity line of credit at maybe like 9%. And I'm just like, all right, well, did you do the math? And I could kind of tell the frame where the person who's sending the email is coming from, because all these people on the internets are kind of saying, oh my goodness, you should always replace the mortgage with the line of credit, right? Because mortgage is simple, or I mean, line of credit is simple interest, and mortgage is amortized interest. And here's the thing, all amortized means is that you have equal monthly payments over a fixed period of time, and it's going to chip off the loan, right? So if you have a loan that's amortized for 1 year, right, you almost pay no interest. In fact, let's just actually do this, right? Let's go to bankrate.com loan amortization, okay? And we'll just do a quick calculation of a loan that's actually not here. Let me just do calculator.net. This is more flexible. .net loan amortization, okay? And then let's do a loan that's amortized for 1 year, okay? And look how much little interest that we pay for that so-called amortized interest. But what's the big deal? What's the deal is that the monthly payment is huge that nobody will be able to afford, right? So um, just because something is amortized does not mean you pay a lot of money, okay? And that's something that we kind of have to understand. So when we throw out terms like simple interest versus amortized interest without really understanding what they mean, and people get really caught up in that, my answer to that is make sure you do the math, right? And that's why I don't tell you or in any video that velocity banking is the best um, method to pay off debt. What I do is I just put spreadsheets on the internet and say, here's me doing velocity banking, right? It's kind of like when you go into Costco and the person at Costco who's doing the demonstrations, they never tell you the product is the best. I'm just saying, here's a sample. Go ahead and try it, right? Or I don't know if you can actually try it, but here's a sample of the strategy. Okay, so point is, just because something is amortized does not mean you'll pay a lot of interest. Okay, this is amortized for 1 year, but the way that it's kind of presented is amortized bad, simple good when loans are calculated with simple interest. Okay, so let me just kind of go back here and take a look at this. And yes, it feels like when I got access to this, I was thinking about, man, I have the infinity gauntlet. you know, all right. So let's go ahead and get started. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. So the average American, the difference between the average American and the velocity banking person is that the average American uses their checking account to pay for things. And when they use their checking account to pay for things, they segregate their income. That is one of the main issues that we're trying to solve, segregation of income. Okay, and so now we have to do two things. And you can see I already kind of did half of the budget, the average American budget. Income at 9,000, expenses at 9,000. We got penny left over, and we have 10 credit cards and a mortgage at 3%, $350,000 at 3%. Okay, so now some of you might be in this cash flow crunch and be thinking, oh my goodness, maybe because of what the internet says, I should replace my entire mortgage and all of my debt with a home equity line of credit. All right. And so if you don't know what a home equity line of credit is, right, all it is a financial tool where you could borrow money, pay it back, and use it over and over again. And home equity, okay? Home equity simply means the amount that your home is worth minus any debts tied to it, usually all the mortgages, right? And so what we're going to do is kind of just do a comparison and figure out, hey, if you're making this income and you're in a cash flow crunch, would it be better to replace all of your debt with a home equity line of credit, including the mortgage, or do it in pieces and think about debt payoff optimization, right? And that's what something I don't hear a lot of too much on the internet about, which is the order that you pay off debt. Okay, all I hear, I'll be honest, it's like, and I think someone actually wrote this comment in the channel where it's like, hey, I actually don't agree with velocity banking, but this is like the only channel that I actually am kind of intrigued by it. Somebody wrote that. It's like, yeah, I'm not impressed, but you know what? I'm gonna take a look. All right, so let's go ahead and do this. So we're having the same income, no savings, and this is kind of like the most important part where you're gonna make your line of credit as your main operating account, meaning once your money hits your checking account, that you make a payment as soon as possible to that line of credit. And so we're gonna go ahead and show that, right? And again, I have over $500,000 in lines of credit, 517. Like I went to the Chase Bank's website and I was like, you know what? I'm gonna get more credit, and then they just gave me $1,000. Bam, right? So, oh, whoopsie, I screwed up here. So this is gonna be zero, and then we're gonna have a concept called cash flow, which looks very similar to savings. Okay, you take a look at this, and you're like, well, it's the kind of the same thing, right? But we got to make our line of credit as our main operating account. So let me scroll here. So what we're going to do is just make two comparisons, right? So let me go ahead and hopefully I'm not like making you dizzy by scrolling all around, although some people complain about that. Like, don't. Here's the thing: don't try to follow math too much by just looking at videos. Do it yourself, and all this will become more apparent, right? So what we're going to do is we're going to compare replacement of the mortgage, right? So mortgage replacement versus incremental payoff. Maybe, and this is what the way that I guess I could define this is maybe paying off not all the debts at a time, but a couple at a time. Okay, depending on various factors, mostly the type of debt, which is you're going to usually do the short-term loans and the credit cards first. Okay, and so let's go ahead and assume, right? So how much is this debt in total? If you add up the 10 credit cards and the mortgage, that's $517,000 of debt, right? So $167,000 of credit cards, you add 350 to it, that's $517,000 of debt. And so let's say the bank, for whatever reason, decided, okay, you know what? We'll give you a first lien HELOC. Maybe your home's worth $600,000 or something like that. And they'll say, okay, let's do that. 517,000. Okay. Now, again, this looks good in the very beginning, right? Because it's like, oh my goodness, now all these payments go away, right? Okay. So now we got $6,800 of cash flow. But remember, this is always cash flow before the interest of the cost of interest of using the line of credit. Okay. So the actual velocity banking strategy is the paycheck. You put your entire paycheck into a line of credit. So you know how like if you have a line of credit, it says, oh, $50 payment required, and you get paid $3,000 a month. You just pay the 3,000. You don't pay the 50, or you could pay the 50 first and then put the 29.50, same day if you want to do that. I don't see a reason to do that, but I just put the whole thing in, right? And you know, you're not going to have any savings, and this is the part that freaks most people out. So if you kind of take a look here, again, I don't have any savings. This is just one of my statement balances, I think like a couple months ago, and start at zero, paycheck comes in, line of credit, end at zero, right? So let me just kind of go back here. And so this looks good. So you put your entire paycheck into the line of credit, and then you take your expenses out of the line of credit, right? And then now this is your cash flow that's going to offset the balance of the line of credit. But here's the thing, okay? Here's why the mortgage is really tricky, All right. So there's this concept called the cash flow index, right? And the higher the number, that's the one you want to pay off last. And so what is a cash flow index? It's just the statement balance of the loan divided by the monthly payment. So 1475.61. Okay. And actually, I probably will put an extra zero here. Okay. And let me go ahead and take away the numerical formatting, the currency formatting. Okay. And so now you see that this is a 237, right? And let me just do a credit card, which is 5,000 divided by 175. Okay. So you see this is a 28 here. So the way that you would interpret this cash flow index is that it's kind of like a ranking system, and you always want to pay off the lowest ones first, and anything above 100 is something called an efficient loan, right? What does efficient mean? Is that you don't get that much bang for your buck for paying off this loan. So for example, let's say instead of like this being debt, let's say you gave this money, $350,000, to kind of like an insurance company in an annuity, right? If you don't know what that means, that's a fancy way of saying, hey, I gave you $350,000 and you only give me $1,475 for 30 years. How'd you like that? You'll be like, that's a terrible deal, right? Because there's not enough bang for your buck, especially in terms of monthly payment, um, for to kind of justify that, right? I mean, unlike an institution like a bank where they deal with many people, if you're just one person and you have $350,000 in savings, and you give it away to to whoever, and in exchange for 1475, that's not worth it, right? So that's why we pay it off last. That's what this number it means. Whereas with, let's say, this 35 grand, I get $1,000 back for paying it off. This 30 grand, I get 1,000, right? So which one should we pay off first? The one that gives us $1,000 for 30 grand, or one that gives us 1,400 for 350, right? So that's why we have to be careful about the mortgage, because this concept rests on getting enough. The pillars of it is about getting enough cash flow to kind of offset that interest rate, right? And so if we replace this mortgage, and heck, we'll replace all of these high interest rate credit cards as well. We're going to compare: is it better to replace everything at once, or just in pieces at a time, right? And we'll just start off with this. Make the comparison simple. So I know that most people don't have a $200,000 home equity line of credit, right? But let's just assume that we did. Well, in this case, 600,000, right? So again, I'm sorry, I'm probably just going all over the place. So now let's go ahead and do the math. So we're going to do replacement first, replace everything. And so to get the next month's balance, well, we got to calculate the next month plus one. The next month's balance is the previous month's balance plus the previous month's interest minus, okay, whatever this cash flow number is, 6821.45. Okay. And then the interest, let me just kind of show you that. That's calculated by the average daily balance. So there's an average formula here, right? And then you might be like, do I pay $513,000 of interest if that's the average? I'm like, no, no. And then now you got to multiply by the interest rate, 0.085. That's 8.5%. And it's like, oh my goodness, do I have to pay 43 grand of interest in a month? No, no. Okay. Calm down, calm down. You divide by 12, right? Because the interest is calculated monthly. So they always quote the interest rate annually, but they calculate it monthly. Okay. And so, but look at this. So now we got 3 grand of interest we got to pay every month, right? Or almost 3,600. Okay. And so we take a look here. So basically, this is $6,800 is not really our cash flow. It's $6,800 plus the cost of the line of credit, okay, which is the interest rate here. So again, let me just kind of go ahead, and we'll see how long it takes to pay off all of our debt. Just a big copy and paste, right? And right. So now just keep going and going and going and going. And right. And so now let's go ahead and we'll say it takes about 109 months. 109 months. And how much interest did we pay? So let's go ahead and calculate that. So now I'm going to go in here, data, and home. Where'd it go? All right. So that's $221,000 of interest. Okay, you just sum up the interest column, and then you get the amount of interest that you paid. So let me go ahead and go back and write the result right here. Okay, so actually, let me do this. What's 109? 109 divided by 12. So 9.08 years and 221,000 in interest. Okay, so that's the result of mortgage replacement, which is kind of a lot, right? Like, I'm looking at this and I feel like, is there a better way? Like, I don't feel like it should take me 9 years to pay off a mortgage. And I say this because I'm spoiled and I paid mine off under 3, right? I'm really spoiled. I know that, right? But here's the thing. If you're going to do this, I want what's best for you. And what I'm going to tell you is just kind of as a joke, but I'm kind of like half winking at you, is that, oh, sorry, somebody called me. Give me 1 second. Okay, sorry, I'm back. So what I was saying is that I'm going to be half winking at you because what I'm going to say is, hey, if you're going to throw away, 30, 60, 90 grand in interest when you don't have to, just give it to me so I could buy a Tesla. Even though technically I've actually never bought a car before, believe it or not, even though I bought 2 homes. So, okay, incremental payoff, right? Meaning that we don't have to replace all of our debt with a home equity line of credit, right? So how can we kind of just do this? So let's just do this again. So what we do is we take up all the cash flow sucking debts, which is the credit cards, because they have the highest interest rates. That's one factor. When it comes to amortized loans, there's 3 factors that comes into play with how much cash flow gets sucked, which is the debt amount, the interest rate, and the time, right? Credit cards, it's just the interest rate and the amount, and it's always variable. Okay, but we want to just get rid of the credit cards first. So that's $167,000. Okay, and we don't need the 600 line. Maybe we just do a 200, right? Doesn't really matter if we leave it at 600, 200. But let's go ahead and do this, and let's restart. Okay, so now, oh, 2 million line. That'd be pretty sweet. All right, so 200,000. And so now what we're going to do is we're going to replace or transfer the credit card debt, right, into the line of credit. And so now let's just do this 0, 0, 0, 0, only with the credit cards, not with the mortgage. Okay, and then here, now our cash flow is $535.45 and not 45 cents, $5,345, right? And 84 cents. Okay. So now let's go ahead and replace this cash flow number. So what am I doing here? It's going crazy. 5345.84. 5345.84. Okay, so now let's go ahead and copy and paste, and copy and paste, and then, all right, so now within about, we'll say 3 years, 36 months, we've paid off the credit cards, right? So let's just do here, so 36 months, and let's just go here, and 21 grand, okay? So that's the first result we get from, let's say, the non-replacement or incremental payoff. So 31, no, 30, did I do 36? Oh, I need to, let me go back, sorry. So 36 and 21, and let me go ahead and copy that. Well, let's do this, 36 months and 21K. So there's 2 components of this since we're paying them off separately. So just for the credit cards, right? It took us about 3 years. Okay. Now, what we got to do is do the mortgage. Now, here's the thing: we're not going to replace the mortgage because we could just do the incremental payoff strategy here, meaning we just kind of chop the loan into pieces, right? And I think people kind of overemphasize like, oh, they're, uh, replacing, well, how do I explain this? I think they overemphasize the line versus loan part, which I don't necessarily agree with. What the line of credit is there to help you for is to maintain control of your cash flow, right? Because here's the thing. So the way I think about it, let's just kind of think about this, right? If you have $5,345 in your savings account right now, what's the likelihood the moment it hits your savings account, you're going to dump it in your mortgage? It's almost like none, right? Like no sane person on this planet will do that because they'll be like, well, what if I need it for emergencies? And so what they do is because the loan is a one-way street, you're not incentivized to ever put that money into the loan. Whereas with the line of credit, because it's a two-way street, right? You could dump it in and take it out whenever you want and still have the same effect. In fact, this is how I kind of think about it, right? So let's say that, and this is kind of like the argument that people make for dumping the money into a loan. So let's say that you had a Netflix membership, right? Netflix membership. And the membership is, let's say, $1 a month. Okay, $1 a month. But you're only restricted from watching from 1 a.m. to 6 a.m. That's kind of like what the loan is. There's a reason why it's priced lower because you don't have access to your money. It's like, hey, kind of like a software package where how there's those like three tiers and the first tier is like free, but you don't get any of the features or the good ones. And then like the super advanced ones, then you get the highly configurable and programmatic features, right? Same thing here with the loan. Yes, it's low interest, and there's kind of like two factors to this interest rate. Number one is risk, and number two is access to your money, right? So the access to your money part determines what the interest rate is, okay? And so if I have a Netflix membership that's like $1 a month from 1 a.m. to 6 a.m., and that's the only time I can watch Netflix, what's the likelihood I'm actually going to watch it even though it's the cheapest option, right? Now, let's assume, okay, that if we have another tier, 110 a month, and you can watch anytime, would you not take that one? Because the difference between here and here is that you're never going to watch a movie in Netflix. Almost never. Most people never watch a movie in Netflix if they were given that option, but they will definitely watch with this option, right? And it's the same thing with the loan and the line of credit. That's really it. Hopefully that makes sense and I didn't ramble on and on. Okay, so now let's go ahead and just quote chunk some of this mortgage into a line of credit and pay it off with that cash flow, right? And so you could just kind of use an amount like 10 grand or something similar to your paycheck. But the most important part of this is that you pay off your mortgage last. Remember that cash flow index number? It was really high. It's like a ranking system. So you want to pay it off correctly, okay? So you can kind of think of it like this. You're still making the monthly payment, but we're going to transfer or make an overpayment of the principal into the line of credit, and we'll just do kind of like 10 grand, right? So let me go ahead and copy this, and then let's go ahead and make 10,000, and so this is when we make our first transfer into that line of credit, and let's go ahead and continue, right? Continue to do that, and what? We paid it off in about, oh my goodness, 2 months? 10 grand in 2 months? That's insane, right? That's insane. But that's why it's important to pay off the debt in a certain order to maximize that cash flow. And even though we're in a 8% interest vehicle, right? How much money did we use for that additional access? Not that much, right? So here, let's take a look. Why did I erase this? But it's like the Netflix membership where it could be a little bit more expensive, right? It could be a little bit more expensive, but the value is you're actually going to do it. That has a lot of value in our society. The fact that you're actually going to do it. And this is something that most people don't talk about. Okay. So let me just pull out this velocity banking calculator here. Okay, and it'll be in my other screen. I'll have it pre-filled out. Let me pause the video, at least on my end, and then pre-fill it out. Actually, before I get to the velocity banking calculator, I just want to show you this is we can calculate, actually this should be 300,000, 350, my bad, at 3% of, if you have the original loan balance, the interest rate, and the loan term, you can automatically calculate the payment amount. And also, if you give the current month, you can get the current balance as well. So that's going to be kind of used to fill in the numbers, so aka the deets of the velocity banking calculator. Now, take a look at this. We already paid off 30 grand of interest. 30 grand. Isn't that crazy? And remember how we paid off like the 10, like how much did we pay off here? We paid off 350 minus 327. How much is that? In 3 years, that's going to be like 23K. So for 23K, we paid 30 in interest, and we only paid 23 of the principal. And remember how we with 10K, we only paid it off in like 2 months? Isn't that crazy? So we're just going to simulate the entire thing into the velocity banking calculator. So now I'm going to switch gears into it. So give me 1 second to copy the current balance, which is 327. Okay, 327, 404.56, 404.56. And what is our current income? So let me switch gears here. Oh, did I? Okay, so let's just go ahead and put in our current income, which is 9321.45. 9321.45. 9321.45. And then what is our expenses is 2,500. So this one's needs to be corrected. Okay, so now you see that it takes 4.3 years and 23.1K to pay off the mortgage. Now, let me just kind of show you, even at this stage, if you replace the mortgage with the line of credit, which is what this calculator, it's smart enough to kind of figure that out. 5 years, and you kind of, how much was that? 75K from 23. It's like you pay $50,000 more in interest. 50,000, isn't that insane? So let me kind of now write in my other sheet, right? So let's go back to the other sheet right here, and we're gonna go in here. And again, this calculator is not mine. It's actually from Renatus, where I first learned velocity banking from, right? And so let me just kind of show you here and right here. And so I actually learned it from here. And to be honest, I actually learned not to replace your mortgage with a line of credit from Renatus. Isn't that crazy? That's why I was like, well, that's not what the class has said. And actually, the Renatus classes also talked about how loan and line interest are kind of the same, right? Like it's funny how some people will say like, well, a line of credit interest is bad, or I'm sorry, loan interest bad because it's amortized. Line of credit interest good is simple. And then in the classes they talk about how they're the same. So I don't know if people pay attention or not, but or people just want to hear what they want to hear. Okay, so now let's go ahead and go back to that velocity banking spreadsheet right here. So for that mortgage, okay. So how long did it take us? Let me look at my other spreadsheet. 4.3 years. And actually, let me write the number of months. I think it has the number of, oh, it has the number of days, but not the number of months, whatever. So we'll just do 4.3 years. 4.3 years. And then how much money in interest? 23.1K. So 23.1K. All right. So let's now kind of calculate the difference, and actually let's calculate the total. So 36 divided by 12 plus 4.3, right? That's 7.3 years. Okay? 7.3 years. Now let's calculate the interest, which is 21 plus 23.1, right? Credit cards plus the mortgage, right? And actually, we actually didn't calculate the other part of the mortgage. My bad. Let me go back here. So we need to add this part, which is 30.5K. So this is the interest we paid as we're paying off the credit cards, right? That's what this is. So let me calculate that as well. So this is going to be, all right. So 30.5K plus, so equals 30.5 plus 23.1, 53.6. Okay, so let me do that. Okay, so now 7.3 years and then 21 is credit card and then mortgage interest is 53.6 and that's 74.6K. Okay, so 74.6K, 74.6K, and then total, right? So that's the total. And then the total here is 9.8. So what's the difference? Difference, okay. So the difference is 9.08 minus 7.3. It's 1.78 years, okay. So we paid off faster using this method right here. And how much less interest do we pay? Well, it's 221 minus 74.6, okay. So that's 146, whoopsie, 146.4K of interest. Folks, I'm kind of winking at you, but if you're in this situation and you're actually thinking of doing this, just give this to me. Just give the 140 grand to me, or maybe just give me 50 grand so I can buy a Tesla. But I don't know what. So here's the thing. The only reason that I would delay paying off debt, right? So it's like for 1.7 years is if this somehow gave me lower interest. So right here it says 74.6 interest or 74,000. And if this was like, oh, pay 30,000 and you got to pay for 1.78 years, I'll be like, all right, I can do that. But if you're going to speed it up, and this isn't even sped up, but if you're going to pay more and pay later, it's like, why? You know what I mean? Like, what? Why would you leave $146,000 on the table? Just give it to me, right? Wink, wink. All right. Oh, okay. So yeah. So again, I know I don't even know how to say this. It's not like I'm frustrated because again, I'm not in a situation where this is going to matter to me. But folks, we got to do the math, right? So, we don't want to just hear buzzwords and say I should do this. We want to make educated decisions. Okay. All right. Well, this is Korean Atlanta mentorship, so you kind of know which one will do it faster and with less interest and with ease. Is it this one, replacing your entire mortgage and all that, or just paying it off in the correct order? Okay. All right. That's it for today. Korean Atlanta mentorship. Have a great day, and we'll speak next time.